Hello and greetings to all. In this video today, we are going to talk about an important aspect, that is component accounting, which comes under IAS 16 property, plant and equipment. Now, large PPE items often comprise of multiple parts and multiple big significant parts with varying useful lives and consumption patterns also. Now, in this situation, IFRS requires that companies need to separately depreciate those parts which are significant. While it sounds, this objective sounds very easy and simple, but implementation can be quite challenging. So let's understand what these complex assets are. Now, complex infrastructures comprising airplanes and ships and buildings and big manufacturing equipments, utilities, etc. They often comprise of multiple parts that need to be periodically replaced and overhauled during their useful life. IFRS 1 basically requires significant part of PPE items with different lives to be depreciated separately. And upon replacement or overhauling of a part, the company is required to capitalize the cost of the new part and de-recognize the carrying amount of the replaced asset. Which means that component accounting basically has 4 steps to be followed. Step 1, we need to identify the significant components of a PPE item. Step 2, determine the cost of each component separately. Step 3, each item of the component, that is each component needs to be depreciated individually. In step 4, we need to replace the components, that is the new component needs to be capitalized and the old component with its carrying value, that is the existing carrying value, needs to be de-recognized. Now let's discuss these steps individually. Step 1 states, identify the significant components of PPE. Now, to apply component approach, it is necessary to identify the significant parts of assets as per IAS 16. Now, IAS 16 basically specifies 2 different types of components. Number 1, the physical component, and number 2, the non-physical component, which would relate to major inspections and overhauling. However, component accounting is intended to be applied only in case of any kind of major inspection or overhauling, and that too when it satisfies 3 conditions. Number 1, it has to be a major expenditure. Number 2, it needs to be done on a regular basis, regular intervals over the life of the asset. And last but not the least, that the benefit of it should be there for a period of more than 1 year. And whatever other costs that is associated with repairs and maintenance need to be expensed as and when incurred. Step 2, we need to determine the cost of individual components. Now, each component is generally measured at cost at the initial recognition. But then there are 2 problems in this case. The first is that it is very difficult for us to know the cost of individual components separately. Why? Because generally when we go and buy a purchase an asset, we pay a total lump sum money for purchasing the asset in totality as a whole and not in parts. So what needs to be done? So the cost of individual components should be estimated either with respect to the current existing market price if possible. If that is not possible, then in consultation with the seller or the contractor. And if that is also not possible, then we need to rely upon any other reasonable method of approximation, maybe the relative values. The second issue that comes up with respect to identifying or calculating the cost of the components is that how we need to allocate the implicit cost of major inspections and overhauling, especially when the asset comprises of a number of physical and non-physical components. And therefore, for that, we adopt the proportionate method. Now, step 3 states depreciate each component separately. Now, components that have been identified in step 1 need to be depreciated over their respective useful life, which may be different, and also in the manner which is consistent with their pattern of consumption. And last but not the least, the final step is that we need to replace the component. Now, once the new component is added, it is replaced and capitalized, the existing remaining carrying amount of the component that has been replaced is to be derecognized. That is the last step, and the component accounting process gets completed. And now any other cost that is associated with replacing the items and which is not identified as significant components are to be expensed as and when they are incurred. That's all for component accounting. I hope I have been able to simplify this complex subject as much as possible for you to understand it in easy steps. Who am I? I am Dr. Jasmine Kaur, creator of Tishads. Now, Tishads is an IFRS learning platform. It has its own USPs where we have used techniques like Avadhana and NLP, and this platform is backed with artificial intelligence. I would like you to suggest and tell me what topics you would like me to pick up so that we can explain it to you in a simplified manner, which is the mission of our organization. In the next video, we're going to talk about IAS 36. We're talking about impairment, value in use, and other aspects that need to be considered. Till then, keep smiling, stay blessed, and bye-bye.